Welcome to Vantage Point Podcast, a podcast brought to you by NWR Communications and 92 Studio. This podcast is intended for education and entertainment purposes only and does not constitute financial advice.
G'day and welcome to the latest episode of Vantage Point, where today we're joined with Andrew Mitchell of Ophir Asset Management. This is the second time that Andrew has been on the podcast, with his first appearance one of the most popular of episodes to date. So we're excited to have him back on and understand his latest positioning, picks from his portfolio and stories of gaining the all-important edge on companies. We hope you enjoy the episode.
Andrew, great to have you back. It's been 9 months since you were last in the studio. A fair bit's happened since.
9 months, hasn't time flown?
I know. It's the end of the year and basically almost reporting season again, which is scary. Maybe for those that didn't listen in last time, I won't get you to go into your sort of personal background, but just Ophir. There's 4 funds. Maybe just go through those quickly before we dive.
So Ophir, Simon, thanks for asking, is and having me back. We're a small mid-cap specialist fund. Why do we like small and mid-caps? Because they're less research. There's less sell-side broker research being written about these companies. And therefore, as a funds management business, what you're paying us to do as an investor is to get out there and really try and work something out that the market hasn't. Put that mosaic together. And it's a lot easier to do in small caps. The bigger the company, the more attention, the harder it is to work something out that the broader market hasn't. So that's why we're small and mid caps. We have 4 funds, essentially the Aussie small cap fund that started in 2012. It's done over 20% after fees return over the last 12 years. Aussie High Conviction Fund, that's listed under OPH as its ticker. I'm just trying to think how much that's done, about 13-14%, don't quote me on that, per annum, beaten its benchmark by several percent a year. That's more of a mid-cap, but it does have some small cap as well. Then we have Global Opportunities, which has been going, that's a global small cap fund, that's been going since 2018, and I think it's beaten its benchmark by 6%, done something like 14-15% per annum for the last, six years. And then the Global High Conviction Fund, which is sort of in line-ish with its benchmark. It's been going for the last 3 years, and that's got the same stocks as the Global Opportunities. It's just, it's got more concentrated of those stocks.
And just in terms of, you obviously got the global and the Aussie, do you get any sort of synergies out of running both, whether it's obviously, you've talked in the past about the Ophir way in terms of detailed due diligence, but is there any sort of synergies that you can glean from global to Aussie and vice versa?
Oh yeah, the synergies are significant because we're seeing trends that are occurring in the US a lot earlier than the Australian market. One, the US market's a lot deeper, so by that, you'll have a $4 or $5 billion company in the US that's a segment of a company, a small cap company that's smaller in Australia. So in terms of that electrification thing, we've been all over that for a while because in the US now, Genus Plus, Southern Cross Electrical, we're probably a little bit later than we should have been to those companies, but because the US companies that we've been invested in, sort of the Powells, the Modine, there's a few of them. They're a lot bigger, so we're able to see it earlier, which enabled us to get into these stocks a bit earlier. So, and we're always talking about global stocks related to Aussie, looking at what they trade on in terms of valuations. And so, the synergies are large. And when we launched the global fund, I said to our investors, we will not launch any fund in the future unless there are significant synergies with the existing fund, whether it's going to make us better on the existing fund, and I certainly believe that it has.
No, that's an important point. And in terms of from a internal sort of machinations of Ophir around sort of macro versus micro, you're talking consistently around an investment edge and picking the right stocks. What can you talk us through the sort of processes around who internally, for instance, runs a sort of macro view and how that dictates any sort of 1 week around the portfolios? Yeah,
there's no one in particular who runs the macro view other than myself and also sometimes Stephen will lead the conversation with the team.
Yep.
Obviously, we've got great access to some of the world's best strategists in the US that we speak to, and we try to put it all together. But what we're trying to achieve with our macro view is not to significantly outperform by taking a view on markets. It's more to protect ourselves, that we don't get hurt, we don't have overexposure somewhere, and just to make sure that we're not caught offside. So we put that all together as a team, and then myself, I'll be going over each of the portfolios and trying to make sure that none of them are out of whack with the risk that they're taking, commensurate to the macroeconomic backdrop. Probably something that you might not even be aware. I am an economist. Originally, I worked at Federal Treasury in the International Economics Division. That was when Peter Costello was the Treasurer. And I also worked at Commonwealth Bank as an economist.
Decent grounding.
So I've got some background in that stuff, but we're not trying to make money out of it. We're trying to just make sure we don't get our faces ripped off by it.
That's a protection mechanism. And I think in the past you've talked about the global high conviction fund. You've got a direct debit set up from your pay. Is that still the case, or is it going to another one of the Ophir funds at the moment?
Yeah, so that's right.
Yep.
There's a direct debit that's set up.
I don't have access to your bank account,
It's actually, I don't want to lie here, it's actually a payment at the moment. The direct debit got taken off for a reason, for a month or two. It's back on, but I'm actually having to pay it once a month into the account now, so it's not. I have to work out how to do the direct debit. This is a discussion I'm having with NAB in the background, literally today, because we're getting to an end of a month, and I need to get that sorted. Yeah, but that's the thing.
So
putting
still,
money in.
Still got the view on the global high conviction fund, obviously.
Yeah. So the money's going into the global high conviction fund for this month. And the idea is the next month and the months after. And the reason, going back to that macro, is I don't feel I'm good at timing.
Yeah.
I want to take that timing element out of it. But what I know is that the market wins in the long term. And so if I just keep investing and not worry about where the market is at any point in time, there's always something to be scared of. The election, what's going to happen in a the different party in power and all those sort of things. I've always got a reason not to invest, so I just want to make sure just keep it simple and put money in all the time.
And in terms of the funds management industry, we talked earlier this morning around the competitive nature. Who's doing what, who's performing what, who's buying what, who's selling, etc.
Yeah.
How do you remain sort of focused around the number one thing that matters most is making money for your investors and unit holders? How do you sort of manage that? Whilst getting the drive, obviously from a competitive side, but how do you sort of look at that?
Well, I personally think being competitive is very important to being a good fund manager, but then also acknowledging you can win a month. It's like winning a battle, but then you lose the war if you take too much risk. So from that point of view, we are always being competitive, but we want to be competing on a 5-year number, less so on than a 1 month number, if that makes sense. So if you don't want to be overly focused on knocking it out of the park every month, because if you do that, then you're actually going to end up pretty poor because you're going to have taken too much risk or not enough risk.
And just probably on that, in terms of the risk, and you talked to performance, how important is position sizing in terms of within the portfolio to actually get that performance?
Yeah, that's a really good question. We talk about it a lot. With portfolios that we have, generally 30 to 40 stocks, so you'll have like a 5% position, but then you'll have a 2% positions. We don't like the 1% positions. We try to cut them out, and you end up with them, and you got to cut them out. The reality is, you find that 5% position that doubles in a year, you kill it, right? It does a lot of the heavy lifting for 1 year for you. But if that stock's a 2% position or 1% position that doubles because you didn't get the position right, then you've got it's a lot harder to have a great year, right? So it's all about position sizing and the work that's been done on our portfolios and why we've been able to generate those returns, especially that original portfolio. What it uncovered, and this is from a big wealth management group, was that our strike rate of getting stocks right versus wrong was really good. But what was more stood out to them was the position sizing was like in the top 1% sort of thing, and that was what was really driving our returns. I think being a fund manager, it's not easy when there's a lot of money at stake. There's a lot of biases, personal behavioural biases, temptations, all those sort of things. And to do really well, you have to be very passionate about it. You need to have a level of anxiety, a level of self-doubt that you're wrong.
Uncomfortable, yeah.
And feel uncomfortable. But then I know why we've been able to get those position sizes right is because it's the amount of work that we do. Once we've established an edge or we've worked something out, we don't just stop there. We keep going and getting more and more confident. I.e., one customer says, or one supplier says, I've supplied a lot into that company in the last 6 months. Well, that's a really good, that sounds like they're growing really fast. But that's just one supplier.
Keep going, yeah.
Keep going. Get 2, 3 suppliers. Now speak to a staff member who used to work there 6 months ago who tells you that they should be doing really well at the moment because of X, Y, Z, and now and just continue to get that level of conviction higher, and that enables you to have that 5% position in the stock that doubles, not the 2% position.
Yeah, and before I sort of get you to talk about the investment edge and an example around a case study, maybe you could just talk to us about people talked about crowded trades, stocks with momentum and whatnot. How do you sort of manage that, whether it's going to a result season or AGM season that we're in now around, is it going to beat, is it going to meet expectations and not getting caught, that it misses expectations and you're in the same stock as the rest of the street, hammering it out. How do you sort of manage that?
Well, you want to know what's well owned to start, right? And so brokers do it for you now. We used to do it ourselves. You don't have to, where you go through the top 5 positions for every fund, and you get an idea of the ones that are well owned. Now, you need to always be thinking about supply and demand for some stocks. We got caught recently. We've owned Zip Money, and we traded some of it down, not because we don't like it, but because we wanted to buy another company, which was Moelis Australia, and they're similar. They're financials and they're leveraged, and the idea was that we'd buy Zip back. But after this quarter, because we weren't quite sure, we still own Zip, so we didn't sell it to zero by any means, but we would buy it back because we weren't sure about this quarter. We're more confident on the next second quarter. Anyway, the quarter comes out. It's a cracking quarter. This first quarter did very well, and I bought it back ex news. Now I hate buying something ex news. I like it a lot more when I've worked something out. The reason I bought it back ex news, well, I shouldn't have sold that stock anyway, because I just used it to fund something else and to manage risk, which I can offset in other ways. But the growth that they're achieving in the US at the moment, this is Zip, is significant. They showed signs of growing customers. What the market has question marks. So getting to that supply and demand dynamic, the thought process in my head is anyone who manages the index, and there's a lot of funds, they probably don't tell you they do this, but they'll be overweight or underweight each company in the Small Ords. So if it's a 2% position in the Small Ords, they might have, we've got 50 bips active, which means it's a 2.5 position, or they might be at 1.5%, which means they're 50 bip under index, or they could be at zero. My feeling is that anyone in that position is going to buy that to 2 straight away to the index position, and it's getting big because I think this next quarter looks good because they've got all these new customers. A lot of stuff not for here to talk about why I think this next quarter looks good.
Yep.
And so I wanted to buy that back immediately on the open
X-News,
when it came X-News, which I hate, is something I really dislike. But I bought it, and we bought it well because we bought it when it was up 5, 6, 7, and I finished the day up 11, 12. It has a tendency to come down on results just because people take profits, but we'll see how that goes. But I'm thinking about the supply and demand of a stock, and I'm thinking about the psyche of the other fund managers in the industry. There's a lot of just sort of playing that Mr. Market. I think it was Benjamin Graham who talked about Mr. Market, the person who wakes up and goes, I'm not sure if I really understand zip money, but it's doing really well, and this could tear my face off or rip my face off because it's in the US, its growth is accelerating, and that's a huge market. I do not want to be underweight on this. And if they all wake up at the same time thinking like that, going, oh, this next quarter looks like it could be good, then the stock rips higher and the valuation doesn't really matter so much at that point in time because it's all supply demand and people managing their own jobs at the end of the day. We talk a lot about that, people managing their jobs, like what's their incentive.
Yeah, no, that makes sense. And so when we talk about the investment edge, and just going back to a sort of example of in the past you talked about Afterpay going over to the US and talking about different retailers. You talked about Transmedics, going to medical conferences and them growing the industry, transplants and whatnot. Is there anything else that you can sort of glean as an edge example? Yeah,
there's in every company we've got different edges. We obviously talk about the ones that are more interesting, companies that we can understand, and probably the ones where we've been able to get an edge, which is, I think people can relate to.
Yeah, exactly. So, that's a good story.
So maybe a good one here, which comes to the top of my. As I said, every single company's got a story. Has got a story about an edge. So we own a business called Wiley. Now, this is established in, I think it's like 1812 or something. It publishes, you probably remember it actually, it publishes textbooks. And and academic journals, right?
Yep.
Now, it's based in New Jersey. It's a $4 billion business. It's growing, we think, quite well. And there's a sort of an AI or the training model angle to it. But their number one competitor is a company. Well, not. There's a. I would say its number one competitor is a company called Springer Nature. Now, this is a German/UK publishing academic journal business as well. The fantastic thing about this business is that it has just listed. So when we bought Wiley, we knew that Springer Nature was thinking about listing. So we flew to London and we met them in London, and they thought we were based in London. And I said, no, we flew here, and they were
blown away.
Whoa! They didn't realise that we were actually, what we were doing was the next quarter, because they're so close to Wiley in terms of academic journals and the submissions for academics. It's a fantastic read-through. So we actually got a great read-through for the Wiley. We thought the quarter was going to be good, but if Springer Nature was seeing academic journal submissions above trend as well, that made us even more confident. And they were. There's an unlisted company. They told us that's fantastic. And the other great thing is we reckon we were a top 5 allocation in their IPO, and the stock's up a good 10-15% since this is Springer Nature then IPO'd, and they were so blown away that we flew all the way to London to see them.
It was like a privilege.
That it was like, we want these guys on our register. So we were able to, I hope they don't listen to this.
I was just thinking about that.
Anyway,
we
like their business. No, for the same reason we like Wiley, we like their business. But it was a 2-pronged reason to go there.
It just sort of validates your original investment thesis, and given Springer Nature is a really good business itself, why not own both and make more money?
Exactly. And that, and what we like, just so people understand them, these academic these journals, they've been digitized so they can sell single journal articles which are higher margin. We don't think the market's reflecting this, and that we think that they're going to grow above trend for a period of time, but the margins are going to be higher than the market expects. And then the other element, which maybe played down a little bit from Springer compared to Wiley, is that those training models used for AI, these guys published, I can't remember the number is crazy. I'm going to be millions out, but how many academic journal articles you've published since 1812 when you've got significant amount of market share I think it's like 4 million, but 2 million maybe. I don't know. It's a huge number. These training models want these academic journals, and so we think that there's going to be some big wholesale sales in there as well, and that these companies don't trade on big multiples at all for defensive growth. For and how many companies do you know have been around? I'm saying Wiley has been around since 1812. It might be 1850s. It's definitely an 18 in front of it, and it's not late 18s either. There's not too many companies like that.
Well, since I was at school, it was definitely around, so at least that's not that long ago. Moving on to the current portfolio.
What do you say? Yeah, I'm saying it was in the 19th century. And you're like, well, it was definitely since 1990.
It was definitely 2000.
It was definitely around in 1995 when I was at school.
Just in terms of the current portfolio, are you happy to talk to any sort of particular interesting position or company that's done well for the fund?
Sure, I can talk about a lot of them. Maybe I know one that you look after. Yep. Generation Life, which is Grant Hackett's. When I say it's Grant Hackett, Grant Hackett is the CEO of this business. It's done phenomenally well for us. They've acquired Lonsec. This was a game changer. We owned it before then, but we were able to really double down and buy a lot of the company in the raising, but also straight after we've loaded up, and the company's up I think 50% in the last 3 months. We're fund managers. We know we speak to a lot of financial advisors, and there's a big move towards managed accounts. Lonsec, Evidentia, they're the big two players, and we think that not only is this segment set for big structural growth, the margins are going to reflect something similar to a funds management margins. And this is happening at a time when Hub and Net Wealth are either in or going into the 100. Small cap fund managers have all made a lot of money there. This sort of looks like the next one, and Hub 24 is now calling out that what Lonsec does, which Generation Life own, is the fastest growing part of their business, and we think they're going to grow. They've currently got 5% of that managed account segment. We think there's a consolidation opportunity which would take them to 15% of a significantly higher number in terms of the market size in 5 years' time. So you put that all through, even though it's up 50%, we're not selling. We think that the valuation looks really scary, but this is an adoption story we think is going to play out for a long time, and we're sitting co-pilot to Grant and his team at Lonsec and at Generation Life, which do the investment bonds, which is doing very well as well. And we're looking forward to that team doing a great job and making us at Ophir look really good. They're doing all the work, because that's what we do at the end of the day.
He's quite the workhorse. Maybe if you just sort of
he's always on a plane. Whenever I call Grant Hackett,
always on a plane.
He is always on a plane. You always catch him in between meetings. He
returns calls very. He's all over.
And he's very good. He is a salesman, right? And that's what you need for that business. And I can't say enough about how impressed I have been seeing how he operates in that drive. And then you go, okay, well, how many gold medals did he win?
Well, so I was gonna use that angle in terms of there's not a whole heap of sort of examples of Olympic gold medalists turned ASX CEO. It's a pretty significant advantage, I would have thought, in terms of having the discipline and drive of the
the work ethic
of the prior.
He knows. I've spoken to Grant about this. I'll steal his thunder. You've probably had him on here several times, but I'd steal his thunder. But I can say it from other perspectives, from other sports people I've met in time. It's sort of like there were people who were better than them who were out there. And Grant will talk about the people that he used to swim against, and they all just fall away over time. People who play cricket for Australia have told me that, like the great thing about, for them was that they were lucky, because if you're a batsman, you just have one bad year when you're in New South Wales at 16, 17, then you're out of the state team, and then it's so hard to get back in. And so you have to have that consistency. And those people who had that bad year when they were 16 and then sort of fell out and had to work really, really hard to get back, it was a bit too hard, and they all fell by the wayside. And then you sort of do the Bradbury or what have you, and come through. And it's all a mental game. As a cricketer, as a swimmer, and maybe as a CEO, maybe as a fund manager as
exactly.
well. You want to be really good. You have to be mentally strong.
And if we more so turn to the sort of personal aspect, you work. Tim Mitchell works within Ophir Funds. Yeah. How's that working with your brother?
The thing, I actually don't work with my brother very much at all because he is my brother, so he'll work with other people in the team. I talk to him about stocks, but he sort of works
on the other side. Almost.
If I was to say the person that I work least with in the business, it would be my brother.
And would that be because you'd be too harsh on each other, or because if you're going to be honest with someone, it's going to be your brother, I would have thought.
My brother's smarter than me, which is good. And it was a real, like you sort of see it as nepotism. Or you hire your brother. The reality was that because he was my brother, that enabled us to hire him. He was like number 1 ranked chemicals ag analyst at Citi, and
that's right.
Worked at Wavestone, and did some great investments over there. And we had an opening, and I felt very bad from taking him from when we were able to get him from the firm that he was at, because they invested a lot in him, but we had to make the move, and so it's worked really well. But it's fantastic having my brother in the business.
With success,
it's more, I run home every day with him, and we just talk about the stuff that we're working on together. But he's not. It's not a super. I work a lot closely with other people in the business than my brother.
And when we talk about running home, we both follow the footy in terms of sort of pre-season. We just had draft week, and now we're going into pre-season. How do you sort of look at funds management, or what you do, in terms of an off-season or pre-season, to give yourself again that edge? In terms of is there a switch-off period where you can stay on and get something?
You never. Well, the thing is, like, what I've learned having children, and family, as a lot of our staff members do, that if you take too much, or not, I've learned, I know that if I take too much in terms of spending time away from my family, then I probably will end up not being able to be a good dad, and things will get a lot tougher. So I'll take a 2-week holiday in July, and probably a 3 to 4 week holiday in December to January, and really make sure that
switch off.
Yeah, but I don't switch off.
Yeah, it's
like, so then I go on the holiday, and my wife's saying, "You're on the phone. Can you get off your phone?" I'm like, "No, I can't. This is the quid pro quo of the industry, that we can go on this holiday." But
and the market's
I'm
over
on the phone.
too.
I'm on the phone the whole time. But I need to do that, and I need to have that time to unwind. But then every other part, in terms of like the pre-season, you need to, before you're going into reporting season, you need to have ticked off every single company that that you're happy with how they're going into each report. You know where the market is. If it's a half-year, quarter, you know where the market is. You have a view of what the market's expecting and why you're expecting something positively different. If there's too many question marks, then, we shouldn't be owning this one. Is that weight right? Is it not? Making sure that you've got your meetings booked in early, that you're not sitting there scrambling and they've already done their roadshow and you don't get a meeting. But then also making sure that in your diary, you don't have too much in one day, because what you can get caught in is sort of that you've back to back companies, and you end up taking nothing in because you're just running to the next company. So quite often a company that I know really, really well, that we own, but I know that there's a couple of others we own that are reporting at the same time, I'll put the one-on-one for the next day when there's not much on, to make sure that I've got the time to spend on these ones, to make sure that I make the right decision, if you know what I mean.
Yeah, no, that makes sense.
So in terms of, do I not go on holidays? Do I just work in July and December and January? It was a lot more like that when I was single, but I've been married for quite a few years now, and so that's a time to spend time with the family. But as I said, you can never switch off from the market because it doesn't switch off. Maybe it switches off for Christmas Day, and then I'm sending the stuff. Merry Christmas. Messages and things like that.
It never stops. I think it's probably the right way of looking at it is you need to have the break to come back hungry and wanting to be there more.
Did you have this at school, Simon? Like this, I don't know if this is just me. I hated school. Well, I didn't hate school. I like school, but then you couldn't wait for the summer holidays, and then you'd get January, February, and then you're like, oh, when's school starting again? I can't wait to get back to school. Then 2 weeks in, you're like, what?
I want it over again.
I cannot believe that I couldn't wait. Couldn't wait to get back to school again.
No,
it's a bit like that in funds management. Yeah, you do want to get back into it, and then you're in reporting season, and then it's like bang, bang, bang. You're like, oh, geez, I wish I was still on in Fiji with the family or something like that.
Well, you're still delivering the results, which is the main thing, and it's all working. So well done, Andrew, and hope you do get to enjoy a nice break upcoming. But thanks very much for having us again.
No, and thanks very much for having me, Simon.
Cheers.
Appreciate
Thanks,
it.
Andrew.
Thanks, mate.